In a single trading session on April 9th, the world's 500 wealthiest people gained $265 billion. The S&P 500 extended its win streak. The Nasdaq pushed higher. On paper, it was one of the best days markets had seen in nearly a year. And yet, on the same day, consumer confidence sat at its lowest point in more than a decade. Americans were skipping restaurant dinners, cutting back on car purchases, and hunting for grocery deals, all while stress over tariffs and affordability was running hotter than at any point since 2013. Two things happened simultaneously on April 9th that should not be able to coexist. The richest people on Earth had their best single day in 12 months, and ordinary Americans reported feeling worse about the economy than at almost any point in recent memory. The trigger was the U.S.-Iran ceasefire. President Trump pulled back his threat that a whole civilization will die tonight, and traders responded immediately. Equity markets surged, risk appetite retained. The Strait of Hormuz, which had been effectively closed, was tentatively reopening, at least in theory. Oil prices slid. Mortgage rates fell for the first time in weeks, according to Freddie Mac's primary mortgage market survey. Every headline screamed relief. But the Strait of Hormuz ceasefire was not what it appeared. Only 5 ships moved through the passage on April 9th, 3 tankers and 2 other vessels, according to S&P Global Market Intelligence data. Iran had pledged a minimum of 15. Bank of America reported that 11 million barrels per day of production remained shut in. The oil market was pricing a peace that had not yet materialized in physical flows.
The gap between market performance and consumer sentiment did not begin on April 9. It has been widening for months, but the ceasefire rally crystallized something that had been building quietly. Asset prices respond to expectations. When geopolitical risk falls, even tentatively, even on 5 ships instead of 15, capital that had been sitting on the sidelines moves fast. Institutional money, algorithmic rebalancing, options positioning, these mechanisms respond within minutes. The world's 500 richest people hold assets. Their net worth moves with markets. The $265 billion gain was arithmetic, not economic activity. Consumer sentiment, by contrast, responds to lived experience. The Conference Board's Confidence Index doesn't care about ceasefire headlines. It measures what people paid at the grocery store last week, whether they feel secure in their jobs, whether they think prices will be lower 6 months from now. On all 3 dimensions, Americans reported deterioration. Meat prices and coffee prices were rising, even as bread prices cooled, according to data tracking the 25 most common grocery staples. Airlines, Delta and Southwest, raised checked bag fees by $10 each, pushing first bag costs to $45. The United States Postal Service suspended pension contributions, citing a looming cash shortfall. These are not abstract indicators. They are the texture of daily financial life. The Federal Reserve wed this same divergence and chose stillness. The February PCE inflation gauge, delayed but finally released, came in at 2.8%. That is above the Fed's 2% target, and it reflected conditions before the Iran conflict began. Cleveland Fed President Beth Hammack, in a direct interview, said it could make sense to raise interest rates if inflation remains elevated. Markets are now pricing a 78% probability of 0 rate cuts in 2026. The futures market has moved further. The idea of a rate hike is no longer theoretical. Here is the inversion. The ceasefire rally lifted asset prices because it reduced geopolitical risk. But reduced geopolitical risk, if it holds, means oil prices stabilize at lower levels. Inflation potentially stays sticky without the supply shock excuse, and the Fed's case for holding rates becomes firmer. The rally that made billionaires richer may have made rate cuts less likely for the consumers who actually need them.
The paradox has a breaking point, and it is measurable. If the Strait of Hormuz fully reopens, not 5 ships, but the 15+ Iran pledged, with sustained tanker flow over the next 2 weeks, oil prices will fall further. Lower oil means lower headline inflation. Lower headline inflation gives the Fed room to pivot earlier than the 78% consensus currently expects. In that scenario, the divergence between market performance and consumer sentiment narrows. Lower borrowing costs, lower fuel prices, and lower imported goods costs would begin feeding through to the economic experience of ordinary Americans. But if the Strait of Hormuz remains at 5 ships, Bank of America's 11 million barrels per day of shut-in production does not come back. Oil prices stabilize or rebound. PCE stays elevated. Beth Hammack's warning about a rate hike stops being a tail risk and starts being consensus. The S&P 500 rally built on ceasefire relief would be sitting on a foundation that hasn't yet been tested by physical reality. The 2020 analog is instructive but imperfect. In April 2020, markets rallied while unemployment surged to 14.7%. The rally was built on Fed liquidity rather than economic recovery. It held, but only because the Fed delivered on the implied promise. Today, the Fed is signaling the opposite. The question is whether equity markets have priced in a Fed that can't cut, or whether they're still running on the assumption that relief is coming. The benchmark to watch is tanker flow through the Strait of Hormuz over the next 5 trading days. If daily ship count moves from 5 toward 15, the rally has a physical foundation. If it stays at 5, the $265 billion gain was built on a headline, not a reality. The weight of evidence today leans toward the gap widening before it narrows. Consumer despair is structural, market relief was event-driven. But if tanker flows normalize faster than expected, that leaning is wrong, and wrong quickly.